Picture this. It's a completely normal Thursday afternoon. The sun is shining, the coffee is brewing, and traders are sitting at their multi-monitor desks in New York and Chicago, just kind of joking around, waiting for the closing bell. The market is humming along exactly like it has every single day for decades. And then, without a single warning light, without a single breaking news alert on the monitors, gravity just completely stops working. The floor absolutely falls out from under the global economy. Okay, let's dive right into this incredibly suspenseful story of a perfectly normal trading day that suddenly turned into a 36-minute freefall. In the literal blink of an eye, the screens flashed blinding red. The smartest, most highly paid financial minds on Earth watched in pure cold sweat as the numbers just kept dropping, and dropping, wiping out $1 trillion. And here's the craziest part. No one knew why. Nobody knew how to stop it. It was a complete and utter mystery. Welcome to our explainer on one of the most terrifying, unexplainable events in modern financial history.
$1 trillion. I want you to let that number actually sink in for a second. That is the exact amount of money that vanished from the U.S. stock market in mere minutes on May 6, 2010. Just think about the sheer weight of that amount. Entire pension funds, life savings, massive corporate valuations, just evaporating into thin air. On trading floors across the country, human beings were literally screaming into telephones. People genuinely thought a major terrorist attack had just happened. They thought a nuclear bomb had gone off somewhere in a major city. Because, markets do not just lose $1 trillion in a matter of seconds unless the world is literally ending. Yet, there was no smoke, there was no fire, there was just this massive, terrifying number burning a hole through the screens, leaving the smartest minds on Wall Street completely and entirely clueless. They had spent decades building the most sophisticated, hyper-fast, artificially intelligent financial machine in human history, and it was currently tearing itself apart right in front of their eyes. And the sheer panic of that afternoon wasn't a slow, steady bleed. No, it was a cliff. At 2:32 p.m., the tremors start. The market begins to slide a bit. At 2:42 p.m., the dam completely breaks. The Dow plunges a massive 600 points. Traders are just frantically mashing their keyboards, trying to sell, trying to buy, trying to do absolutely anything to stop the bleeding. But the machines are way too fast. 5 minutes later, at 2:47 p.m., the Dow hits rock bottom. It is down almost 1,000 points. We are talking about the biggest intraday point drop in the history of the market. People are just staring at their glowing screens with their mouths open in shock. And then, the absolute craziest part happens. By 3:08 p.m., the market just magically recovers. It bounces right back up like nothing ever happened. 36 minutes of pure, unadulterated terror, and then it's just over. Like a ghost just walked through the room, leaving everyone utterly bewildered. But the damage to the illusion of safety? Yeah, that was permanently done. During that brief, dark window, the algorithms completely broke down. We are talking about shares of some of the biggest, most incredibly stable blue-chip companies in the entire world. Companies like Accenture, Procter & Gamble, the companies that make the everyday products sitting in your bathroom right now. For a few terrifying minutes, the trading bots completely lost their minds. They priced shares of these massive, multi-billion-dollar global corporations at a single penny. You could have theoretically bought a piece of a global empire for the loose lint in your pocket. Meanwhile, other completely random stocks suddenly spiked up to $100,000 a share. The system was basically hallucinating. The machines had gone entirely blind. So, let's move into part one of this mystery, searching for the spark and the desperate scramble for answers. In the immediate aftermath, no one actually knew what triggered this catastrophic financial avalanche. The dust finally settled, the closing bell rang, and Wall Street was basically left standing in the wreckage, looking around, asking one very simple question. What on earth just happened? And you have to understand, the US government, the Securities and Exchange Commission, the absolute brightest regulators in the world, they all had absolutely zero idea. The very people tasked with keeping the market safe were totally blind. So they started looking for a villain. They started hunting for a ghost. The theories started flying immediately. Regulators frantically grasped at anything that made even a little bit of sense. Was it a fat finger error? Like, did some tired trader just accidentally add an extra zero to a massive sell order and accidentally crash the world? It sounded plausible, but the math just didn't add up. Was it a high-frequency trading meltdown? Did the supercomputers just suddenly turn on each other? Was it, quote, stuffing, technical glitches, delayed data feeds? Or maybe was it one giant, completely legal directional bet by a firm called Waddell & Reed that just tipped the boat over? Regulators spent months poring through mountains of data, but none of these theories fully explained the sheer fragility the market displayed that day. None of it explained the true spark. So the mystery dragged on for years. Wall Street eventually moved on, but investigators, they kept quietly digging into the data. Which brings us to part 2, the Hound of Hounslow, and the ultimate plot twist in this entire saga. Because it actually took 5 long years of dead ends to finally pull back the curtain. 5 long years of false leads and head-scratching. And the truth? Well, the truth was stranger than absolutely any fiction a Hollywood writer could ever invent. Because the culprit wasn't some rogue, highly advanced AI. It wasn't an evil, secretive hedge fund operating out of a dark glass skyscraper in Manhattan. It wasn't a complex syndicate of international cybercriminals. It was a single, lone day trader named Navinder Singh Sarao. The media eventually dubbed him the Hound of Hounslow, and his story turns everything we know about the power of global finance completely upside down. Just look at this contrast. On one side, you have Wall Street, the Goliath. Multi-billion-dollar high-frequency trading firms. These are people who spend hundreds of millions of dollars just to lay down perfectly straight fiber optic cables across mountains, just to shave a single microsecond off their trade times. They employ armies of PhD physicists and elite algorithms. And on the other side, you have David, Navinder Sarao. He lived in Hounslow, which is a quiet, working-class suburb of London. He traded from his childhood bedroom in his parents' semi-detached house. Let me repeat that. His room was literally still decorated with stuffed animals. He was so incredibly frugal that he traveled to work late just to get off-peak train tickets, and he routinely used discount coupons to buy his lunch at McDonald's. It's this massive, hilarious inversion where the hyper-sophisticated Wall Street machine was quite literally brought to its knees by a guy in sweatpants.
And the crucial thing you need to know is that Sarao didn't use some massive billion-dollar supercomputer to pull this off. He didn't hack into the secure mainframe of the New York Stock Exchange. He had no special insider access whatsoever. He utilized a basic setup worth just £1,400. He used completely commercially available off-the-shelf trading software. That's it. A standard computer setup you could literally go out and buy at your local electronics store right now. And with that tiny 1,400-pound weapon, he somehow managed to terrify the most advanced, expensive trading algorithms on the planet.
All right, part 3, the art of spoofing. Let's break down exactly how you fake out a $1 trillion market. You see, Sarao didn't hack the market. He didn't break any complex encryptions or steal passwords. He simply exploited a glaring, fatal weakness in exactly how those highly advanced machines were programmed to think. He used a tactic known in the dark corners of the financial world as spoofing. He realized that the Wall Street algorithms were incredibly fast, sure, but they were also incredibly stupid. They reacted entirely to the illusion of danger. And Sarao, well, he became a master illusionist. Now, spoofing is the illegal practice of placing massive bids or offers in the market with the strict, absolute intent to cancel them before they ever actually execute. It creates a completely false illusion of massive supply or demand. But to make this really relatable, think of it like this. Imagine walking into a super crowded movie theater. You really want a front row seat, but it's totally full. So you stand at the back and yell fire at the top of your lungs. Everyone panics. They drop their popcorn, they stampede out the back doors. The seats completely clear out. And then you just calmly walk to the front row, sit right down, and casually pick up all the wallets and loose change left behind by the fleeing crowd. You created a fake panic to get a real discount. That, in a nutshell, is spoofing.
This slide perfectly breaks down the trap Sarao ran. It was genius, yet incredibly simple. Step 1, he would place massive, giant fake sell orders just above the current market price. We're talking millions of dollars worth of downward pressure. Step 2, the high-frequency bots on Wall Street would instantly see this massive wall of sell orders coming, but they don't know it's fake. They don't have human intuition. They just see danger. So they panic and they drop their own prices just to get out of the way. Step 3, Sarao smoothly steps in and buys the heavily discounted assets at the dip. And step 4, and this is the real magic trick, he instantly cancels every single one of his fake sell orders. The danger just magically disappears. The bots realize the threat is gone, the price snaps right back up to normal, and Sarao calmly sells his cheap assets into that sudden rebound for a pure risk-free profit. He ran this exact same trap thousands and thousands of times over several years, perfectly predicting exactly how the automated trading bots would react.
And on the exact day of the flash crash, he decided to turn his little machine up to 11. Just prior to the market plunging, Sarao replaced or modified his massive fake E-mini S&P 500 futures orders a staggering 19,000 times. Just let that sink in for a second. 19,000 modifications in a tiny, tiny window of time. He was rapidly flashing a massive wall of fake supply. The algorithmic bots on Wall Street were completely terrified. They genuinely thought a massive tidal wave of selling was about to drown the market. So they started pulling back, they started running away, and the liquidity, which is the very lifeblood of the market, started to completely dry up.
Now for part 4, a fragile system exposed. This is where the spark meets the powder keg. Because here is where the narrative really shifts, and we have to look at the mature reality of the situation. Sarao actually didn't cause the crash all by himself. Honestly, he was just a guy playing a high-stakes video game in his bedroom. He just happened to strike a match in a room that Wall Street had already secretly filled to the brim with gasoline. The system was already deeply, fundamentally flawed. It was a massive powder keg just waiting for a spark. And on May 6, 2010, the stars just aligned for a perfect disaster. When official investigators from the Commodity Futures Trading Commission finally pieced the whole timeline together, they found the real nightmare scenario. They discovered that Sarao's intense, relentless spoofing collided at the exact wrong millisecond with a massive but perfectly legal sell order from a real mutual fund. This fund was just trying to legitimately hedge its portfolio. But because Sarao had terrified all the buyers away with his fake orders, when the real mutual fund tried to sell, there was absolutely no one there to catch it. They completely exhausted all the fundamental buyers in the market. It was literally like stepping on the brakes of your car on the highway and suddenly realizing someone has cut the brake lines.
The Securities and Exchange Commission described what happened next as this disastrous hot potato effect. Once all the fundamental human buyers were gone, the only ones left in the market were the high-frequency trading bots. And they completely panicked. They started rapidly passing these toxic contracts back and forth among themselves at the speed of light, just trying desperately to get rid of them. Buy, sell, over and over, just like a deadly game of hot potato. And every single time they passed it, the price dropped lower and lower. They were literally feeding off each other's panic, draining all remaining liquidity from the entire global system in a matter of seconds. The machines quite literally traded the market straight into the ground. As John Bates over at Traders Magazine so perfectly put it, blaming the flash crash on a UK man who lives with his parents is like blaming lightning for starting a fire. Yes, the lightning is the spark, obviously, but the lightning didn't pile up all the dry wood in the forest. Sarao merely exposed the terrifying reality that modern markets, which are utterly dominated by automated machines just chasing each other's digital shadows, were fundamentally incredibly unstable. Wall Street had built an ecosystem so fragile that a single guy eating discount McDonald's in his childhood bedroom could accidentally tip the whole thing over.
Which brings us to our final section, Part 5, Aftermath and Market Evolution, Rebuilding the Guardrails.
Following this unprecedented meltdown, the silence on Wall Street was absolutely deafening. The entire financial world was abruptly forced to wake up from its delusion of total control. They realized with a cold sweat that they had handed the keys to the global economy over to robots without bothering to install any brakes. They had to completely rewrite the rules of engagement, and fast. They had to rebuild the guardrails before a real, prolonged crisis wiped them out for good. So regulators finally took action. The Dodd-Frank Act of 2010 formally defined spoofing as illegal market manipulation. They finally gave the ghost a name and a serious penalty. Furthermore, regulators realized that if a guy in his bedroom across the Atlantic could shake Wall Street to its very core, they desperately needed cross-border cooperation. But more importantly, the exchanges finally implemented new automated circuit breakers, structural pauses. Now, if the market drops too fast, the system automatically halts trading. It just pulls the plug. It gives human beings time to breathe, to step in, and to actually stop the machines from destroying the world during moments of extreme, unpredictable volatility. But I know what you're wondering. What actually happened to Navinder Sarao? Well, the twist ending to Sarao's story is almost as shocking as the crash itself. When they finally tracked him down and arrested him in 2015, everyone expected him to be locked away in a dark cell for life. But during the trial, a completely different picture emerged. Sarao was diagnosed with severe Asperger's syndrome. To him, he viewed the stock market like a giant, fascinating video game. He wasn't motivated by malicious greed at all. He lived an exceptionally modest life and actually lost most of his profits to bad, shady investments anyway. He eventually surrendered $7.6 million to the United States. But more importantly than the money, he provided extraordinary, unprecedented cooperation to the Department of Justice. He literally sat down and showed the US government exactly how all the other spoofers and high-frequency cheats were gaming the system. Because of his profound, deep help, instead of spending decades in a federal prison, he earned just one single year of confinement. And the real irony? He served it in that very same childhood bedroom where the whole thing started. So as we close out this explainer, I want to leave you with one final, provocative thought. Yes, they arrested the Hound of Hounslow. Yes, they finally implemented new circuit breakers and outlawed spoofing. But the core reality remains completely unchanged. The machines, they are still out there. They are still trading in milliseconds, fighting invisible, lightning-fast wars over fractions of a penny. If the system was truly that fragile back in 2010, are we actually safe from the next trillion-dollar glitch today?
Or have we just built a slightly better powder keg, and we're all just sitting around, totally blind, waiting for the next spark?